Financial Accounting. This is Tyler Vocelka with Corie Overton and Jaime Flores. We're presenting our financial overview of 4 companies which are listed here. For our analysis, we chose AIG, US Bancorp, Wells Fargo Company, and Fairfax Financial Holdings. The purpose of this analysis is to evaluate which would be the best opportunity for investment. And so we measured their volume growth and value, their ROE, their cash flows, and came to a conclusion on which one would be the best for an investment. Volume herein stands for the quantity of financial services a company provides for profit and essentially their power within the industry. An increase in sales volume leads to a net income earnings per share. It leads to increases in net income earnings per share. Growth refers to a company's historical financial data used to determine trends in their sales volume and net income and to estimate where they're headed in the future. The value of a company is a comparison of a company's fiscal year end, the FYE, share prices to their earnings per share value to determine a company's return on investment or their price to earnings or PE ratio. I'd like to invite one of my associates to explain the company comparison.
So this is an overview of how well our companies stand in those metrics that Tyler just described. As you can see, our clear winners are FFH. They're the most appealing for investment, and this is due to their high standings. Their sales volumes could be better. However, if you look at their growth in both volume and net income, you can see that they are just leaps and bounds above the other companies, and then their value is actually lower than the other ones, but that's preferable since that means that their price per share is less. So you're going to get more for less money, so that makes them the better buy. So now we're going to go into profitability, efficiency, and leverage. And as you can see, profitability is just a measure of net income over net sales. So it's how much the company is spending in relation to how much they're taking in as profit, how much they're retaining. And then efficiency is net sales over assets. So it's how much they're taking in, and then how much of that money they're using to invest in assets. So a high efficiency ratio means they're decreasing those assets needed to increase sales. So that's a good thing. And then leverage is assets over equity, so it's how much the company is borrowing to increase their assets. And then this is an overview of return on equity. So their net income over their equity, so it's how much they're borrowing to increase their income. And then you can see the rankings of our companies again. And again, FFH is the better investment because not only can they control expenses and retain part of their revenue as a profit, they can use their assets efficiently, again, to generate revenue. And then as you can see by their leverage, they are using the money that they are taking in efficiently, so they don't have to borrow as much from other companies, so they don't have that dangerous equity that some other companies are falling into at this time.
We'll talk about cash flows and the way a company gets their money for operating activities. One is operating activities, then it's investing, and then there's financing activities. From operating activities, the cash effects of revenue and expenses related to the core business activities. Examples would be sales to customers and services, interest and dividends. And that's an example of inflow. Outflow would be purchase merchandise or plants or assets that allow you to make more money based on those purchases. And investing is the cash effects of transactions related to plant assets, intangible assets, and investments themselves. Also, this is where you can invest in your company by either getting rid of assets that aren't being productive, and so you get rid of those and purchase other ones that are going to make you more. So financing activities is the cash effects from debit and equity financing transactions, and that is that's where you invest in other companies, and it's just like a customer investing on a company. You invest in other companies and reap the benefits if you made a good investment. Our financial industries, as you can see our numbers, you have USB, US Bank at JFH, and Wells Fargo. Wells Fargo is at the bottom of it. So their operating activities, they're losing money on their operating activities, while USB is making the most money. And investing, AIG, this is kind of misleading figure. They're investing a lot, but this isn't such a good thing because it's they're not making a lot of money, so they're investing, but they're not reaping any benefits. FFH is doing the best. And financing activities, Wells Fargo has a ton, but they're overdoing. They're kind of killing their overall net cash flows because of their financing activities. And analyzing the companies, obviously Fairfax Financial offers is like the best company that we can come up with for investments. And the reason is their cash flow from operating activities, and they're successful, and they're also selling their services. An inflow of cash and investing activities most likely from proceeds from collecting principal amounts on loans, and a moderate cash outflow in financing activities, most likely due to a healthy amount of money being paid to owners. So overall, Fairfax Financial is our best company that we can invest in.
We're the financial industry, and we think that Fairfax Financial Holdings was a very clear winner because,
based on our analysis, their net income is healthy. They're not making as much as the other big companies, but it's because they're a smaller company. But based on the size of their company, then based on previous years, they are growing, and that's more than the other companies are doing. So even though they're not making as much, their income is not as high. They are growing, and also they are. It's impressive that they're making money right now because the current state of the economy, and they're growing as a company at a time when all the other companies are not, and I think that's impressive. Also, if they are growing right now, then obviously it shows that they can grow in the future when everybody has more willingness to invest. So I think that it's a big part of why we chose them, and the fact that in the future they're going to grow. So.
Another beneficial part of Fairfax Financial Holding is looking at their ROE, or their return on equity. They are definitely one of the front runners within the financial industry because they aren't dividing their company up as much between owners as some of the other companies are doing. So that means the people who are investing within Fairfax Financial Holdings are getting larger returns than some of the others who their company is divided up between a larger number of owners or people that have invested within this company. So that's obviously a great reason to invest because you're going to get more money back for how much you have put in. So that's always a good thing and another reason to invest within this company.
And as far as cash flows are concerned, Fairfax Financial Holdings has a reasonable cash inflow from operating activities and was very successful in selling their financial services, again, in an economic hardship. Inflow from cash from investing activities is most likely due from the proceeds collected through principal amounts on loans. And only a moderate outflow in financial activities, relatively speaking, according to the rest of the data. This was most likely due to a healthy amount of money being paid to the owners. And those are the reasons why we think Fairfax Financial Holdings is the clear winner. Thank you very much.